The complete Series 7 Exam Cram Audiobook. Introduction. Welcome to the Series 7 Exam Cram Audiobook. My name isn't important. What is important is the information in this program and your commitment to mastering it. I'm a veteran financial securities trainer who has prepared thousands of candidates for their FINRA licensing exams. This audiobook is the culmination of that experience, designed to give you the most critical, most testable information in a direct, no-nonsense format. Purpose of the Series 7 exam. The official purpose of the Series 7, the General Securities Representative Qualification Examination, is to assess the competency of an entry-level registered representative to perform their job. In simple terms, this exam is the primary license required to buy or sell most types of securities for customers. It tests your knowledge of the four critical functions you'll perform: seeking business for your firm, opening customer accounts, providing suitable recommendations, and executing transactions. Passing this exam demonstrates you have the foundational knowledge to be a competent and ethical professional in the securities industry. A simpler view. Think of the Series 7 as the financial world's version of a driver's license. Before you can get behind the wheel of a car and take passengers, customers, you have to pass a test to prove you know the rules of the road, securities regulations, and how to operate the vehicle safely, handle investments. This exam is that test. How to use this cram audiobook effectively. This is not a lecture. It's an active study tool. Do not listen to this in the background. Your success depends on your active engagement with the material. Follow these instructions precisely. Find a quiet place where you can focus without distractions. The single most important instruction is this: pause and repeat until you can explain it out loud. When I cover a concept, a rule, or a definition, pause the audio. Try to explain it back to yourself in your own words. If you can't, rewind and listen again. Repeat this process until you can articulate the concept clearly. If you can't explain it, you don't know it well enough for the exam. This audiobook is structured in a bullet point, high-density format. It's designed for maximum retention in minimum time. Pay close attention to the mnemonics and simplified explanations. They're designed to anchor complex topics in your memory. The final chapter, the Quickfire Review Blitz, is designed for you to listen to on the morning of your exam. It'll prime your short-term memory with the most essential facts, formulas, and rules right before you walk into the testing center. Let's begin. Function 1. Seeks business for the broker-dealer, 7%. Chapter 1. Communications and Advertising Rules. This chapter covers how you, as a representative, and your firm can communicate with the public. The core principle to remember is that the rules are based on the audience you're speaking to. The less sophisticated the investor, the stricter the rules. FINRA's primary goal is to protect the public, especially retail investors, from misleading information. A simpler view. Think about how a doctor communicates. When speaking with another specialist, they can use complex medical jargon. But when explaining a diagnosis to a patient, they must use simple, clear language to ensure understanding and avoid causing panic. The rules for financial communication work the same way. The more general the audience, the simpler and more regulated the message must be to prevent misunderstandings. FINRA Rule 2210, the three categories of communication. FINRA Rule 2210 divides all communications into three categories based on the audience. Instead of a table, let's break them down one by one. First, we have retail communication. Definition. This is any written communication, including electronic messages, sent to more than 25 retail investors within any 30-day period. This is your broadcast category, like advertisements or sales literature. Approval. Because it reaches the widest audience, it requires pre-use approval by a qualified registered principal. Second, there's correspondence. Definition. This includes any written or electronic communication sent to 25 or fewer retail investors within a 30-day period. Think of personal emails to individual clients. Approval. This is subject to supervision and can be reviewed either before or after it's sent. It does not require pre-approval unless it's a promotional piece sent to 25 or more existing clients. Third is institutional communication. Definition. This is any communication distributed only to institutional investors, like banks, insurance companies, or mutual funds. Approval. This is the most lenient category. No principal pre-approval is needed. It's just subject to the firm's own written rules. Specific product and regulator rules. These are additional, more specific rules for certain products and from certain regulators. A simpler view. If the general communication rules are the basic traffic laws, these are the special rules for specific vehicles. The rules for driving a motorcycle, like options, are stricter than for a regular car because it's riskier. FINRA Rule 2220, Options Communications. Options are complex, so their ads are even stricter. All retail communications about options must be pre-approved by a registered options principal, ROP. If an ad is used before the customer gets the options disclosure document, OD, it must be filed with FINRA 10 days prior to use. MSRB Rule G21, Municipal Securities Advertising. This applies the principles of fair dealing and not misleading to ads for municipal bonds. All ads must be approved in writing by a municipal securities principal or general securities principal before first use. SEC Rules, the Anti-Fraud Foundation. SEC Rule 156, for mutual funds, this is a simple but powerful anti-fraud rule. It is illegal to use sales material that is materially misleading. SEC Rule 482. This allows for shorter mutual fund ads, but they must state that past performance doesn't guarantee future results and tell people how to get the full, detailed prospectus. SEC Rule 498. This is the Summary Prospectus Rule. It lets funds send a short, easy-to-read summary to investors instead of the massive full prospectus, as long as the full version is available online. Quiet period and research reports. Quiet period. When a company plans an IPO, the company and its bankers are restricted from hyping the stock to the public before the SEC gives the green light. Research reports. These are detailed analyses. FINRA requires them to be fair, balanced, and disclose any risks. Prospectus. This is the official owner's manual for a new stock offering. It contains all the critical information an investor needs. Chapter 2. New Issues and Public Offerings. This chapter details how a company goes from being private to being publicly traded, and the rules governing offerings that are exempt from this process. The IPO process, a step-by-step guide. An initial public offering, IPO, is a company's first sale of stock to the public. Step 1. Select an investment bank. The company selects a lead underwriter to manage the process. Step 2. Due diligence and registration. The underwriter prepares and files a registration statement, Form S-1, with the SEC. This filing begins the cooling-off period. Step 3. The cooling-off period. This is a minimum 20-day period where the SEC reviews the filing. Underwriters cannot sell the securities yet, but they can gauge investor interest by circulating a preliminary prospectus, also known as a red herring. Step 4. Effective date and pricing. Once the SEC declares the registration effective, the company and underwriters finalize the public offering price, POP. The stock can now be sold to the public. A simpler view. Imagine a popular local restaurant chain wants to expand nationwide. To get the money for new locations, they decide to sell shares of the company to the public. 1. Hiring the experts. They hire a top financial firm, the investment bank, to handle the sale. 2. Creating the report. This team creates a detailed report on the restaurant's finances and risks, the registration statement, and gives it to a government agency, the SEC, for review. 3. Gauging interest. While waiting for approval, they can show a coming soon version of the report, the red herring, to big investors to see who might be interested. 4. Going public. Once the agency approves, they set a final price for the shares and start selling. The restaurant is now a public company. The underwriting syndicate and spread. Syndicate roles. Lead manager, bookrunner, the main investment bank managing the entire IPO process. Syndicate members, other investment banks that help sell the securities and share in the risk. Selling group, broker-dealers that assist in selling shares but take no financial risk for unsold shares. They earn a selling concession. The underwriting spread. This is the underwriter's compensation. It's the difference between the price they pay the issuer and the public offering price, POP. It has 3 parts. Manager's fee, paid to the lead manager. Underwriting fee, paid to syndicate members for taking on risk. Selling concession, the largest part, paid to the firm that actually sells the shares. Mnemonic. A typical split is 20% manager's fee, 20% underwriting fee, and 60% selling concession. A simpler view. The lead manager is like the general contractor for building a house. The syndicate members are the subcontractors, plumbers, electricians, who share the work and the risk. The selling group are like real estate agents who just find buyers but didn't help build the house. The spread is their total payment, which they split up based on who did what. Exempt offerings, bypassing full SEC registration. Full SEC registration is costly and time-consuming. These exemptions are like legal shortcuts for raising money under specific conditions. Let's review the key exemptions one by one. Regulation D is for a private placement. What it's for: selling securities privately to a select group, not the general public. Key investor type: accredited investors, people or institutions who are financially sophisticated. Dollar limit: there is no limit to how much money can be raised. Key restriction: the securities sold are restricted, meaning they can't be immediately resold to the public. Regulation A+ is for a mini IPO. What it's for: letting smaller companies raise money from the general public with less paperwork. Dollar limit: up to $75 million per year. Key feature: requires a simplified offering circular instead of a full prospectus. The securities are not restricted. Rule 144 governs the resale of stock. What it's for: it's not for raising new money. It's the rule that allows holders of restricted and control stock to sell it to the public. Key restriction: there are volume limits on how much can be sold, and restricted stock has a 6-month holding period. Rule 147 is for an intrastate offering. What it's for: a local business raising money from local investors in a single state. Key investor type: in-state residents only. 100% of purchasers must live in that one state. Key restriction: the securities can't be resold to out-of-state residents for 6 months. Function 2. Opens accounts and profiles customers, 9%. Chapter 3. Types of accounts. This chapter covers the different brokerage accounts you can open. The account type determines what a customer can do and how the assets are owned. Cash versus margin accounts. Cash account, the most basic account. The customer must pay for all purchases in full by the settlement date. No borrowing is allowed. Margin account allows a customer to borrow money from the firm to purchase securities, using those securities as collateral. This use of borrowed money is called leverage. Leverage magnifies both potential gains and potential losses. A simpler view: a cash account is like using a debit card. You can only invest the money you actually have. A margin account is like getting a loan from the brokerage firm, using the stocks you buy as collateral. This loan, or leverage, lets you buy more stock than you could with your cash alone. It can amplify your gains, but it also amplifies your losses, and you're required to pay back the loan regardless of how your investments perform. Specialized account types. Pattern day trader, PDT, a customer who executes 4 or more day trades within 5 consecutive business days in a margin account. Key rule: a PDT must maintain a minimum equity balance of $25,000 at all times. Prime brokerage account, a bundled service for very large and active clients, like hedge funds. A single prime broker provides trade execution, clearing, custody, financing, and other services. A simpler view: a pattern day trader is like a pro gamer who plays so much they get special rules and requirements. The $25,000 minimum is like having to maintain a certain rank to keep your pro status. A prime brokerage account is like an all-inclusive, VIP concierge service for a hedge fund. Instead of having separate companies for trading, holding assets, and getting loans, one prime broker does it all for them. Account registrations. Who owns the assets? This is about who legally owns the account. Individual account, owned by one person. Joint accounts, owned by 2 or more people. Let's compare the 2 main types. In a joint tenants with rights of survivorship, JTWROS, account, if one owner dies, their share automatically goes to the surviving owner. It avoids the legal process of probate and is common for married couples. In a tenants in common, TIC, account, if one owner dies, their share goes to their estate or a beneficiary they named, not the other account owner. This type allows for unequal ownership. Corporate account, opened by a corporation. Requires a corporate resolution, which is a legal document from the board of directors saying who can trade for the company. Trust account, managed by a trustee for a beneficiary. Requires a copy of the trust agreement, which is the rule book for the trust. A simpler view: Think of JTWROS as a last one standing wins account. Think of TIC as an account where each owner has their own separate piece of the pie that they can leave to whomever they want in their will. Opening a corporate or trust account is like opening an account for someone else. You need official proof, the resolution or trust agreement, that you have the authority to do so. Retirement and education accounts. These are accounts with special tax breaks to encourage saving for specific goals. A simpler view. Think of these accounts as special savings jars with a gift from the government. The gift is that the money inside can grow without being taxed every year, which helps it grow much faster. The only catch is you have to follow the rules for using the money. Let's break down the most common ones. Traditional IRA. You contribute with pre-tax money, which might lower your taxes today. The money grows tax deferred, but you pay ordinary income tax on it when you take it out in retirement. Roth IRA. You contribute with after-tax money, so there's no tax break today. However, the money grows tax-free, and qualified withdrawals in retirement are completely tax-free. 401k plan. This is an employer-sponsored retirement plan. It works like a traditional or Roth IRA, but your employer might also contribute money for you, which is called a match. 529 plan. This is a state-sponsored plan for education savings. You contribute with after-tax money, but the growth and withdrawals are tax-free if used for qualified education expenses, like college tuition. Coverdell ESA, a smaller education account with a low contribution limit, $2,000 per year. It's similar to a 529 but has more restrictions. UGMA, UTMA accounts. These are custodial accounts for a minor. Money you put in is an irrevocable gift to the child. UGMA is for gifts of cash and securities. UTMA is more flexible and allows for any type of property, like real estate. Mnemonic. The T in UTMA stands for transfers, and you can transfer anything. Chapter 4. Customer Information and Suitability. This chapter focuses on the rules for gathering customer information and using it to make appropriate recommendations. This is a heavily tested area. Know Your Customer, KYC, and Customer Identification Program, CIP. FINRA Rule 2090, Know Your Customer, KYC. Requires firms to use reasonable diligence to know and retain the essential facts about every customer. USA Patriot Act, Customer Identification Program, CIP. An anti-money laundering, AML, rule that mandates firms verify the identity of every person opening an account. At a minimum, the firm must obtain these 4 pieces of information: name, date of birth, physical address, and a social security number for U.S. citizens. AML red flags. Be alert for red flags indicating money laundering, such as unusual secrecy, transactions that don't make sense for the customer, or structuring, making many small deposits to stay under the $10,000 reporting threshold. Suitability and Regulation Best Interest. FINRA Rule 2111, the Suitability Rule, states that a firm must have a reasonable basis to believe a recommended transaction is suitable for the customer, based on their investment profile, age, financial situation, objectives, risk tolerance, etc. Regulation Best Interest, Reg B, establishes a higher standard of conduct than suitability for recommendations to retail customers. It requires a broker-dealer to act in the best interest of the customer, without placing the firm's financial interests ahead of the customer's. A simpler view. Let's break these crucial rules down with an analogy. KYC, CIP. This is like opening a bank account. The bank needs to verify your name, address, and social security number to confirm your identity and comply with federal law to prevent crime. Suitability. This is like a doctor prescribing medication. A doctor needs to understand your medical history, allergies, and current condition before recommending a treatment. Similarly, a representative must understand your financial situation, goals, and risk tolerance before recommending an investment. Regulation Best Interest, Reg B. This takes suitability a step further. Imagine a doctor could choose between 2 equally effective drugs, but one provides them with a bigger payment from the drug company. Reg B is like a rule that says the doctor must act in the patient's best medical interest, without letting their own financial incentive get in the way. It's about putting the client's interests first, period. Function 3. Recommendations, Records, and Assets, 73%. Chapter 5. Securities Overview. This is the largest function on the exam, covering the products you will recommend. You must know these inside and out. Stocks, equities. Common stock represents ownership, grants voting rights, and has the highest potential for growth and risk. Paid last in a liquidation. Preferred stock, an equity security with bond-like features. Pays a fixed dividend and has priority over common stock, but usually has no voting rights. A simpler view. Common stock is like being a part owner of a sports team. You get to vote on major decisions, and if the team becomes wildly successful, the value of your ownership can skyrocket. But if the team goes bankrupt, you get paid last, if at all. Preferred stock is like having a VIP season ticket with a guaranteed seat and a free hot dog at every game. You don't get to vote on who the coach is, but you get your dividend, the hot dog, before the common owners get anything. It's safer, with less potential for huge gains. Rights and warrants. Rights, preemptive rights, short-term options given to existing shareholders to let them maintain their ownership percentage when new stock is issued. Exercise price is below the market price. Warrants, long-term options often attached to bonds as a sweetener. Exercise price is above the market price at issue. A simpler view. Rights are like a members-only coupon that lets you buy new shares at a discount before the public can, so your ownership doesn't get diluted. Warrants are like a lottery ticket that comes free with a bond purchase. It gives you the chance to buy the stock at a set price years from now, which will only be valuable if the stock price goes way up. Bonds, debt securities. When you buy a bond, you're lending money to an issuer in exchange for interest payments and repayment of the principal, $1,000 par value, at maturity. A simpler view. Buying a bond is like being the bank. You lend money to a company or government, the issuer, and they give you an IOU. They promise to pay you regular interest payments for a set period, and at the end, they pay you your original loan back in full. It's generally safer than owning stock. Types of bonds. Corporate bonds, loans to companies. U.S. government securities, the safest loans, made to the U.S. government. Municipal bonds, munis, loans to states and cities. Their interest is often federally tax exempt. General obligation, GO, bonds, backed by the taxing power of the issuer. Revenue bonds, backed by revenues from a specific project, e.g., a toll bridge. A simpler view. A GO bond is like lending money to your town, secured by its promise to pay you back using its ability to collect taxes from everyone. It's very safe. A revenue bond is like lending money to build a new concert venue, and you only get paid back from ticket sales and concessions from that specific venue. It's only as safe as the project is successful. Bond yields and ratings. Bond yields. These measure a bond's return. The most important relationship to know is the inverse relationship between price and yield. When a bond's price goes up, its yield goes down, and vice versa. Think of a seesaw. Bond ratings. These are a bond's credit score. Let's describe the rating scale instead of using a table. Think of bond ratings like a report card from agencies like S&P and Moody's. First, you have investment-grade bonds, which are considered safer. The highest quality is rated AAA by S&P and AAA by Moody's. A step down is high quality, rated AA by S&P and A by Moody's. The scale continues down through single A and then triple B. The lowest investment grade rating is BBB from S&P or Ba3 from Moody's. Anything rated below that falls into the speculative grade, also known as junk bonds. These are riskier but offer higher yields. The highest level of junk bond is rated BB by S&P and Ba by Moody's. The ratings go down from there, indicating increasing risk of default. Packaged products, investment companies. These products pool money from many investors into a single, professionally managed investment. Mutual funds, open-end funds, a diversified pool of securities. Shares are bought from and sold back to the fund itself. Priced once per day at net asset value, NAV. Exchange-traded funds, ETFs, a basket of securities that trades on an exchange like a stock. Its price fluctuates all day. Unit investment trusts, UITs, a fixed, unmanaged portfolio of securities that has a set termination date. A simpler view. A mutual fund is like a potluck dinner where everyone chips in money, and a professional chef, the fund manager, buys a variety of ingredients to create a diversified meal. An ETF is also a potluck dinner, but you can buy and sell your plate of food all day long at the stock market diner. Most ETF chefs are just trying to perfectly copy a famous recipe, like the S&P 500 index. A UIT is like a pre-packaged meal kit. The ingredients are chosen once, put in the box, and that's it. There's no chef making changes. You just hold the box until the use by date. Annuities and other products. Annuities, contracts with an insurance company for retirement income. A fixed annuity is an insurance product. A variable annuity is a security because the investor bears the risk. The key benefit is tax-deferred growth. Real estate investment trusts, REITs, companies that own or finance income-producing real estate. They trade like stocks and must distribute at least 90% of their taxable income as dividends. Direct participation programs, DPPs, investments, typically limited partnerships, that pass through all financial results directly to investors. They are high risk and illiquid. Options, a contract giving the buyer the right, not the obligation, to buy or sell a security. A call option is a right to buy. You're bullish. A put option is a right to sell. You're bearish. A simpler view, a variable annuity is like a mutual fund wrapped in an insurance policy. It gives you investment choices and tax-deferred growth, with the goal of creating a personal pension plan. A REIT is a way to invest in a portfolio of large real estate properties, like office buildings or shopping malls, without having to buy the whole building yourself. It's like being a landlord without the hassle. A DPP is like being a silent partner in a business venture, like an oil and gas drilling operation. You share directly in the profits and losses, which can be great for taxes but is very risky. Options are like putting a deposit down to lock in a price. A call option is like paying a fee to lock in the price to buy a concert ticket later. You're betting the price will go up. A put option is like buying insurance on your ticket, giving you the right to sell it back at a set price if the band becomes unpopular. Chapter 6. Analysis and Strategy. This chapter covers the two main schools of thought for analyzing securities and portfolio theories. Fundamental versus technical analysis. Fundamental analysis tries to determine a company's true value by studying its financials, like EPS and P/E ratio, management, and economic health. Technical analysis tries to predict future prices by studying historical market data, primarily price and volume charts, looking for patterns like support and resistance. A simpler view, a fundamental analyst is like a detective investigating a company. They read all the financial reports, interview management, and study the industry to decide what the company is really worth. A technical analyst is like a meteorologist who doesn't care about the science of weather. They just study past weather charts, believing that all the complex factors are already reflected in the patterns, and use those patterns to predict tomorrow's weather. Modern portfolio theory, MPT. Diversification, the core principle. Spreading investments across various assets to reduce overall portfolio risk. Beta. A measure of a stock's volatility relative to the market. A beta of 1 means it moves with the market. A beta of 1.5 means it's 50% more volatile. Capital Asset Pricing Model, CAPM, a model to determine an asset's expected return based on its risk, beta. A simpler view, diversification is the old saying, don't put all your eggs in one basket. If you drop the basket, you lose everything. By spreading your investments, a loss in one area can be offset by a gain in another. Beta is like a stock's personality. A high beta stock is dramatic and overreacts to everything the market does. A low beta stock is calm and stable. CAPM is a formula that tries to answer the question, for the amount of risk I'm taking with this stock, what return should I be getting? Chapter 7. Taxation. Understanding tax implications is a critical function of a representative. Taxation of investment income. Capital gains, a profit from selling an asset. Short-term capital gain, asset held 1 year or less. Taxed at your higher, ordinary income rate. Long-term capital gain, asset held more than 1 year. Taxed at lower, preferential rates. A simpler view, the government rewards you for being a patient investor. If you buy a stock and sell it quickly for a profit, short-term, you pay taxes at the same high rate as your job income. If you hold it for over a year, long-term, you get a tax discount. Calculating gains and losses and the wash sale rule. Cost basis, your purchase price plus any commissions. Formula, sales proceeds minus cost basis equals gain or loss. Wash sale rule, you cannot claim a tax loss if you buy a substantially identical security within 30 days before or after the sale. A simpler view, cost basis is simply what you paid for the investment. Your taxable profit is what you sold it for, minus what you paid. The wash sale rule prevents you from cheating on your taxes. You can't sell a stock on Monday to claim a loss, then buy it right back on Tuesday. The IRS says that's not a real loss, and they will disallow it. Special tax rules. Gifting versus inheriting securities. Gifting. When a security is gifted, the recipient takes the donor's original, lower cost basis, carryover basis. Inheriting. When a security is inherited, the cost basis is stepped up to the market value on the date of death. A simpler view. It is almost always better for tax purposes to inherit an appreciated stock than to be gifted it. If you inherit it, all the past gains are wiped away for tax purposes, and you start fresh. If you are gifted it, you also inherit the original owner's built-in tax bill. Chapter 8. Disclosures and Client Communication. Clear and timely communication is a regulatory requirement. Key disclosure documents and processes. Prospectus delivery. For IPOs, a prospectus must be delivered to buyers in the secondary market for 25 days, for listed stocks, or 90 days, for unlisted stocks. Trade confirmations. A receipt for a trade, sent at or before settlement. It must disclose key info, including whether the firm acted as an agent, charging a commission, or principal, selling from its own inventory. ACATS transfers. The automated system to transfer an account from one brokerage firm to another. A simpler view. A prospectus is the official owner's manual for a new security. A trade confirmation is the receipt for your purchase. Agent versus principal. When your firm acts as an agent, they're like a real estate agent finding a house for you and charging a commission. When they act as a principal, they're like a car dealer selling you a car directly off their lot. This must be disclosed. ACATS is like the post office for your brokerage account, securely moving all your stocks and bonds from your old firm to your new one without you having to sell anything. Function 4. Transactions and Execution, 11%. Chapter 9. Orders and Settlement. This chapter covers the mechanics of how trades are placed and finalized. Order types. Market order. Execute immediately at the best available price. Guarantees execution, not price. Limit order. Execute at a specific price or better. Guarantees price, not execution. Stop order, stop loss, triggers when a stock hits a stop price, at which point it becomes a market order. A simpler view. A market order says, get me in or out of this stock right now. I don't care about the exact price. A limit order says, I'm only willing to buy or sell at this specific price or a better one. If I can't get my price, I don't want the trade. A stop order is a defensive order sitting on the sidelines. It's an instruction that says, if the stock price drops to this level, get me out immediately to stop my losses. Settlement. T+1 settlement. The standard settlement cycle for most securities, including stocks, corporate bonds, municipal bonds, and ETFs, is 1 business day after the trade date, T+1. A simpler view. Settlement is when the ownership of the security and the cash officially change hands after you make a trade. Think of it like closing on a house. The trade date is when you agree to the price. The settlement date, now just 1 business day later, T+1, is when you get the keys and the seller gets the money. Chapter 10. Errors, Complaints and Margin. This final chapter covers what to do when things go wrong and the rules for borrowing money in a margin account. Handling errors and complaints. Trade errors. A representative must report any error to a principal immediately. The firm is responsible for any losses. Customer complaints. A complaint is any written grievance. It must be forwarded to a principal. Arbitration. Most brokerage agreements require disputes to be settled through binding arbitration rather than court. A simpler view. If you make a trade error, you must report it immediately. Think of it like, if you see something, say something. The firm eats any losses. You can't let the customer pay for your mistake. Arbitration is like having a private judge settle a dispute instead of going through a long, expensive public court case. It's the standard way to resolve serious conflicts in the brokerage industry. Margin. The rules of leverage. Regulation T, Reg T. The initial margin requirement is 50%. You must put down at least half the money for a purchase. Maintenance margin. The minimum equity that must be maintained in the account. FINRA's minimum is 25% for long positions. If you fall below this, you get a margin call. Special Memorandum Account, SMA. A line of credit created when your equity rises above the 50% Reg T requirement. A simpler view. Reg T is the down payment rule. You have to put down at least 50% to get the loan. Maintenance margin is the bank's safety net. If the value of your collateral, your stock, drops too low, they issue a margin call, which means you must add more money to the account immediately or they will start selling your stock to cover the loan. SMA is like your home equity line of credit, HELOC. As the value of your stocks goes up, your equity increases. That excess equity becomes a line of credit, SMA, that you can borrow from. Margin agreements and disclosures. Hypothecation agreement. The customer pledges their securities as collateral for the loan. Rehypothecation. The firm can use the customer's pledged securities as collateral for its own loans. The firm can repledge up to 140% of the customer's debit balance. A simpler view. Hypothecation is you giving your broker permission to use your stocks as collateral for your loan. Rehypothecation is the broker then using that collateral to get their own loan from a bigger bank. The key number to remember is that they can only pledge up to 140% of what you owe them. Final chapter. Quickfire Review Blitz. This is your final review. Listen to this on the morning of your exam to get the key facts fresh in your mind. I'll ask a question, pause briefly, and then give the answer. What are the three types of communications under FINRA Rule 2210? Retail, correspondence, and institutional. What is the investor threshold for a communication to be considered retail? More than 25 retail investors in 30 days. Who must approve retail communication before use? A qualified registered principal. Who must approve options advertising? A registered options principal, ROP. What is the document circulated during an IPO's cooling-off period? The preliminary prospectus, or red herring. What are the three components of the underwriting spread? Manager's fee, underwriting fee, and selling concession. What is the typical holding period for restricted stock under Rule 144? 6 months for a reporting company. What is the key requirement for a Rule 147 intrastate offering? All purchasers must be residents of that one state. What is the main difference between a cash account and a margin account? Leverage. What is the minimum equity requirement for a pattern day trader? $25,000. How do assets pass upon death in a JTWROS account? Automatically to the surviving owner. Are contributions to a Roth IRA pre-tax or after-tax? After-tax. What are the 4 critical pieces of information required by the Customer Identification Program, CIP? Name, date of birth, physical address, and identification number, SSN. What are the 3 suitability obligations under Rule 2111? Reasonable basis, customer-specific, and quantitative. What is the core principle of regulation best interest, Reg B? To act in the retail customer's best interest and not place the firm's interests ahead of the customer's. What is the key difference between common stock and preferred stock? Common stock has voting rights, preferred stock pays a fixed dividend. What is the difference between a right and a warrant? Rights are short-term with an exercise price below market. Warrants are long-term with an exercise price above market. What is the dividing line between investment grade and junk bonds for S&P? BBB is the lowest investment grade. BB Plus is the highest junk grade. What is the formula for current yield? Annual interest divided by current market price. What is the 90% rule for rights? They must distribute at least 90% of their taxable income as dividends. What is the tax consequence of inheriting stock? The cost basis is stepped up to the market value on the date of death. What is the wash sale rule window? 30 days before the sale, the day of the sale, and 30 days after the sale, a 61-day window. What is the 60/40ths rule? For Section 1256 contracts, 60% of gains, losses are long-term and 40% are short-term. What is the standard settlement cycle for equities and corporate bonds? T+1, 1 business day after the trade date. What is a stop order? An order that becomes a market order when a specific price is reached. What is the Reg T initial margin requirement? 50%. What is the FINRA minimum maintenance margin for a long position? 25% of the long market value. What is SMA in a margin account? A line of credit created by excess equity. How much of a customer's pledged securities can a firm rehypothecate? Up to 140% of the customer's debit balance. This concludes the Series 7 Exam Cram Audiobook. Review the sections where you hesitated. Practice explaining the concepts out loud. You have the knowledge. Go in with confidence and execute. Good luck.